Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the complex world of corporate filings. Today we're looking at LiveOne Incorporated's latest report, and let's just say things are getting a little more compact. Did they just shrink their company? Alright, so LiveOne Incorporated, known for its various digital media and entertainment platforms, has just filed an 8K report detailing a pretty significant change. The big news here is something called a reverse stock split. Now before you get worried, this doesn't mean the company is actually shrinking its business. It is more like a mathematical adjustment to the shares. Basically, for every 10 shares of common stock you owned before this split, you'll now have 1 share. Think of it like cutting a pizza into 10 smaller slices, then reassembling those slices into one larger slice. The amount of pizza you have doesn't change, but the number of slices does. This typically happens when a company's stock price is very low. Why do this? Well, Nasdaq has listing standards, and one of those is often a minimum stock price. When a stock price goes too low, it risks being delisted. A reverse stock split is a way to artificially boost that share price back up to meet these requirements. LiveOne plans to do this on the 26th of September. The good news is, if you're a shareholder, your trading symbol ELVO isn't changing. So, from a ticker perspective, it is business as usual. However, the number of shares you hold will be 1/10 of what it was. If you hold your shares through a broker, this split happens automatically in your account. No action needed from your side. If you have old paper stock certificates, you'll need to follow instructions to exchange them for new ones that reflect the split. Now, the decision to do this wasn't made overnight. The shareholders actually approved a range for this reverse split back in September, and the board of directors ultimately decided on the 1-for-10 ratio. This indicates a need to lift the share price to stay compliant with Nasdaq rules. It is important to understand that this split also affects other things like stock options and warrants. The number of shares associated with these will be adjusted, and so will the price you can exercise them at. So, if you had a stock option for 100 shares at $1 each, after a 1-for-10 split, you might have an option for 10 shares at $10 each. The company itself flags that many of their statements are forward-looking, meaning they are predictions about the future. This is standard practice, especially when discussing efforts to regain compliance with listing standards. It's a reminder that while they are taking steps now, future success is not guaranteed. And they also state they don't have a specific obligation to update these future predictions unless the law requires it. This is common language to manage expectations and legal liability. Now, looking at the bigger picture for LiveOne, this reverse stock split is a clear signal that they are in a situation where their stock price is very low. Companies usually resort to this to avoid delisting from major exchanges like Nasdaq. While it can help maintain a listing, it doesn't inherently solve the underlying business issues that led to the low stock price in the first place. Think of it as putting a bandage on a wound. The real work is what happens operationally and financially to improve the company's value. LiveOne operates in a competitive digital media space, and the success of this maneuver will ultimately depend on their ability to grow revenue, manage costs, and turn a profit. Without that, even with a higher stock price, the company will continue to face challenges. The fact that they needed shareholder approval for a range, and then the board chose the most aggressive split, suggests a strong internal consensus that this action was necessary to stay listed. We'll be watching closely to see if this move allows them the breathing room to execute their business strategy and improve their financial health. It is a crucial step, but it is just one step in what will likely be a long road. So, what is my take on LiveOne's latest move? This reverse stock split is a survival tactic. It's not a growth strategy, but a way to stay on the Nasdaq's radar and avoid being kicked off. The big question is, what is driving the low stock price? Are they struggling with revenue, profitability, or perhaps market perception? The filing itself doesn't get into those deep financial details in this section, but the need for this split strongly implies underlying financial weakness. The risk here is that if the company's core business doesn't improve, the stock price will likely just fall again, even after the split. The opportunity, however, is that by remaining listed, they can still access capital markets and attract investors to fund their recovery. It's a delicate balance. Alright, that is our breakdown of LiveOne's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.